This morning we got a very good quarter from Dover. The classic diversified industrial manufacturers made a big pivot toward the data center, aerospace, clean energy. Stock shot up more than 8% today. Good news for me, it's a big charitable trust holding. Now, technically, some people would call it a mixed to positive quarter. Dover's total revenue and its organic sales growth both fell a tad shy of expectations, but they also delivered an 11-cent earnings beat off a $2.51 basis. Management raised their full-year earnings forecast. Remember, Dover's the kind of real economy stock that hasn't done as much this year as I would like, but that's because, well, you don't need to report a perfect, picture-perfect quarter for the stock to rally like crazy, given the stock was ready to go. Could this be the beginning of a longer-term move higher? Let's check in with Rich Tobin. He's the chairman, president, and CEO of Dover Corporation. Mr. Tobin, congrats on the quarter. Welcome back to Mad Money.
Hi, Jim. Good to see you.
Rich, I got to tell you, I never understood why the stock fell where it did, and that's not your job to predict the stock, but it is your job to predict margins, and you are saying you don't think anything, you're looking for growth in all of your different businesses in next year.
Yeah, that's correct. I mean, we do a pretty fulsome strategic planning process in the September timeframe, where we go through business by business and take a look at new product launches, competitive stacks, and the like. And in this year is a unique one where I think over the last 3 years, we'd had a counter-cyclical headwind in maybe one or two of our businesses, just because cycle on, cycle off. In this particular one, we don't see it.
Well, that's terrific, because I know I've been worried about some of the businesses, but I'll tell you what I've not been worried about, Sikora, this electrical infrastructure business, which is the kind of thing I'm looking for Dover, because I want to invest in a company like that, and that's what you do as the steward of your capital at Dover.
Yeah, look, I mean, part of our business model clearly is M&A. As you know, we went through a period where valuations are a bit stretched coming out of COVID with very low interest rates. Then we've had pretty much a paucity of assets. I mean, I think if you look at M&A and global investment banking, the numbers would show that it's up quite a bit. The middle market, not so much. So we've been kicking the can on a variety of assets. That one, I would say, is a semi-proprietary deal. We had already been working with that company in terms of incorporated or inspection technology. When we learned about it, we just said, hey, wait a minute, this is something we want to own.
All right, so Rich, what do we do with companies like a company that does refrigerated cases or a company in the canning business, historically businesses that might have grown more than they do now? I mean, some people would argue that refrigerators are actually in some sort of secular decline because we don't build as many places that might need them. Do you look at these businesses as businesses that are, don't worry, they have their own cycles and the cycles can come back?
We both the cycle of the business itself and then the competitive stack. For the most part, we participate in relatively small TAM markets with very concentrated customer bases. So even on the replacement cycle alone, when you talk about like retail refrigerating equipment, that's probably got somewhere between a 5 to 7 year life. So the entire footprint of these retail stores gets replaced over that period of time. So as you know, what we try to avoid is markets where there's too many suppliers for a limited low growth market, and then you can get in a little bit of trouble. But by and large, when we look at the competitive stacks of where we participate, even in something as basic as retail refrigeration, we like our position.
Okay, now I don't want to repeat something that was asked directly by Steve Tusa, a very good analyst, J.P. Morgan, but when you saw your stock at 160, we were pretty aggressive buyers for the trust. And the reason why we were, and we were hoping you were too, but is we said this is absurd. There isn't anything about Dover that would merit this decline. But you bought some, that you have a lot of cash left. So I must believe that you see many things that are more attractive than your stock. I couldn't find anything more attractive, but you may think there are things more attractive.
I think as we went through the year, the funnel in terms of possible M&A was quite fulsome at the time. A lot of things dropped off. Either the asset didn't come to market or we stepped away for a variety of different reasons, and we were preserving that capital. I think that we've been open and honest and said, look, we're not going to sit on a ton of liquidity. As you know, we divested some businesses last year, so we're very liquid right now. My expectation is based on the share price. Even after today's rally, we still think it's cheap, so I would expect that we'll intervene on the stock price.
Excellent. Now, last time you were on was around Liberation Day. And that was, I spent way too much of our interview talking about tariffs because everybody was talking about tariffs. It looks like it's been a bit of a cost of doing business, but no more than that. I didn't see any of your businesses really slugged by it.
We discussed this before. I mean, we're very much a proximity manufacturer, so the supply chains are not global in nature. I mean, we're not immune to it. And again, I think just because of the niche quality of our business and the highly engineered components, we do have an amount of pricing power to offset any headwinds we get.
And then the two businesses I really love, obviously, like everybody, so it's not really that original. Anything levered to LNG exports and anything levered to the data center. I like the mosaic of businesses that you have. Would you ever double down on those, or would that get rid of the concept of having multiple businesses in different areas?
I would tell you that anything that is even modestly exposed to AI build-out has gotten extremely expensive. So I think that we'd be lean into our own product development there, and we've got a variety of different avenues to participate, whether it's the thermal connectors, whether it's the brazed plate heat exchangers. So we're all around the cooling units today, and I think that we've got a pretty good, robust IP plan around what we see how that market would develop over time. On the precursor components, it's a bit of an interesting market right now. We sell into the turbine manufacturers with internal parts. As you know, the backlogs are there. I mean, the volumes are significantly high. What we don't see yet is the midstream components that are going to deliver the gas to these turbines. And our expectation is in the back half of 2026, there's going to have to be significant spending in pipeline and distribution infrastructure to supply those turbines, and we've got a healthy position there.
Well, I know that's going to be an excellent business. I know that from the GE Vernova. We spoke to the CEO yesterday. That's exactly the sweet spot, and that's great news for us. I want to thank Rich Tobin, Chairman, President, and CEO of Dover Corporation, one of the longest continuous dividend players, and a great mosaic that isn't tied to any particular industry. Rich, thank you for coming back on the show.
Thanks, Jim.
Mad Money's back after the break.